This is Chris Whalen, CPA, and welcome to my podcast. Today we're going to be talking about the new tax reform and its impact on families. Since the Tax Act was passed, I've been developing detailed scenarios based on real-life fact patterns so I can educate my clients as to what the ramifications are of the new tax laws within various income brackets and with varying itemized deductions. My goal here is to answer the question I've been getting almost constantly for the past month. How will the new law impact my income tax bill? You will see that the impact may not be severe, but in fact it may produce a net decrease in total tax. In this case study, we have a married couple with 2 children earning $230,000 a year. They have a full assortment of itemized deductions, including property taxes, mortgage interest, state income taxes, and charity. Most of us have heard that after 2017, the property tax and state income tax deductions, or SALT deductions, are limited to a gross amount of $10,000 combined. This will come into play shortly. If you take a look at the spreadsheet now on your screen, I will compare the current 2017 rates and the new 2018 rates against the same financial fact pattern and show the net increase or decrease in the total tax bill. Here are the facts used for this case study. We have a married couple with 2 children. Their income is $230,000. Their state taxes are $12,000 and property taxes are $9,200. Their mortgage interest is $16,000 and their charity is $2,000. So let's take a look at 2017 before any changes to the tax code. This might be familiar to a lot of you. So we see the $230,000 in wages. And so we have an adjusted gross income of $230,000. We then have the itemized deductions that I just detailed for you, and those total $39,200. Now they also in 2017 get personal exemptions of a total of $16,200, which also reduces taxable income. So this brings our taxable income in 2017 down to $174,600. When we calculate the tax on that, and this includes alternative minimum tax, the total tax is $36,472. I think we can all follow that. So now let's apply the same facts to 2018, and let's go to the top of that column. We have $230,000 in wages and the same adjusted gross income of $230,000. Now please take a look at the state taxes and property taxes line under itemized deductions. The combination of those two, as I stated above, cannot exceed $10,000. So we only have $5,000 of state taxes we can deduct and $5,000 of property taxes we can deduct. This is one of the main areas of fear and hysteria I've been hearing about, and we'll get to that in a minute. Mortgage interest is still 100% deductible up to certain limits, and that is still $16,000. Charity is still deductible at $2,000, so that brings our itemized deductions in 2018 to $28,000. Take a look at the total itemized deductions line, and we have an $11,000 approximate reduction in itemized deductions. And I purposely made this example with some very high deductions so we can easily see how the new law is going to work. Now we also have another negative here. Look at the personal exemptions line. There are 0 allowed in 2018 because they've been eliminated. That is an additional $16,200 of deductions lost in 2018 compared to 2017. So that brings our taxable income in 2018 to $202,000. Now just looking at that difference between the taxable income lines, we have almost $28,000 in higher taxable income in 2018. We went from $174,000 approximately to $202,000. Most people would think this is a doomsday scenario, and I understand why. But if you look at the taxes calculated in 2018, they are only $586 higher than the 2017 tax. How can that be? This is because a few things have happened. Number one, the income tax rates have been reduced from last year, and also the tiers have increased, so when you go into a higher bracket of tax for some of your income, that's also been moved up. So in this scenario, even limiting the SALT deductions to $10,000, we have a very slight increase in tax only, but we're not done. This family, with the fantastic changes to the child tax credit rules, are now eligible for a $2,000 per child tax credit, where in 2017 they had none. Now their net 2018 tax is only $33,058, which now means a $3,414 reduction in tax overall for 2018 over 2017. Of course, this is only an example and every situation is different, and that's why I highly recommend anyone with a concern, such as people thinking of buying a home, to engage my firm to do a custom analysis for them based on their personal financial facts. As always, I appreciate you listening to this podcast. I hope you found it informative and worthwhile. Do you have any tax, accounting, or business questions? Please contact me via my website at chriswhalencpa.com. You can also reach me via email at chriswhalencpa@gmail.com and call me directly on 732-673-0510. Thank you again, and I'm looking forward to answering all of your questions.